To tell us more, I'm joined in by my colleague Snehi Shah. Snehi, tell us more. How do the numbers look like?
Excellent set of numbers coming in, Shivani. That is the first reading on the numbers. If you take a look at the numbers, it's coming at 8.2% on a year-on-year basis. The street estimate or the Bloomberg consensus was at 7.4%. Here at ET now, we had built in a poll of 7.3% with a target range of anywhere between 6 and 8.5%. This number that's coming at 8.2% is in fact towards the upper end of our band. So looking very good. That's the first initial take coming in. GDP at 8.2%. Let me take you through some of the more numbers that we have that are just trickling in on the wires right now. The GVA addition has come in at 8.1%, gross value added, looking healthy over there, beating an estimate of 7.3% as well. And remember, this is the third or fourth consecutive quarter, in fact, where we have seen the number come in above 7%, and this time around the number has come in above 8% as well. So how sustainable is that? We'll be getting into an interaction with our economists and experts on the show in about a minute. Before that, let me tell you what some of the numbers are. The farm growth has come in at 3.5%. Mining growth, a slight blip, but very, very nominal blip coming in, almost a flat move on the mining growth number. Manufacturing growth looking healthy at 9.1%. Power and gas have done okay at 4.5%. You have telecom growth of 7.5%, so looking good over there as well. The construction growth has come in at 7.2% on a year-on-year basis. We also have the fiscal deficit number that's just trickled in, and the deficit has reached 52.6% of the total FY target. So let's make sense of all of these numbers that have just trickled in. To do that, we have Ms. Aditi Nayar, the Chief Economist at ICRA, Garima Kapoor, Economist and Senior Vice President at Elara Capital, and Debopam Chaudhary, the Chief Economist at Piramal Finance, joining us on the show. Thank you everyone for your time, and let's start with you, Aditi. Your first take off the bat of this GDP number, better than our and the Bloomberg consensus estimate. Has it beat your estimates as well?
Oh, absolutely. I think, now this is the second quarter where we got an initial GDP growth print, which is much higher than what the consensus was. We were at the lower end of the range this time. We had a GVA growth forecast of 7.1% for this quarter, and it's actually come in at 8.1%. So, large deviation as compared to our estimate. And I think the main reason for this is the services sector. So while agriculture and industry are in line with our forecast, the service sector growth has come in much higher than what we expected, which is a little surprising given the fact that we did see quite a bit of slowdown between Q1 and Q2 in the growth of government expenditure, which was one of the main reasons why we thought that the service sector growth was going to slow down. So yes, definitely much higher than expected. And we'll have to see again, we'll have to revisit our forecast for H2 in light of this average 8% growth in the first half of FY2026 to really understand going ahead between the competing sort of impacts of the trade uncertainty and the GST buoyancy, how H2 is likely to pan out.
A revision on the positive side, on the upside, it's sounding good going ahead for the economy. Garima, weigh in over here and talk to us about what you have made of this number, if you are going to be making any changes on the upside to your overall FY26 GDP target, and also the sectors you think have led to this kind of growth. Has it largely been on the basis of the agriculture economy?
The number is really blockbuster. So, of course, the full year number that we have, which is already above what RBI's own estimates are, will have to be revised upwards, because you'll now be tracking, even if you assume and take into projection the quarter 4 to be somewhat softer than quarter 3, because you will have some moderation of the front loading of exports, plus some impact playing out in terms of uncertainty relating to government spending, as your normal GDP is going to be weaker. Yet your full year numbers will probably now track a number close to 7.4 to 7.5%. That will be like way above even the higher estimate that the government, that the CA had itself put out in the early part of the year. Now, a significant part of this growth is driven by manufacturing, because there was a front loading of exports. Remember, when you had anticipated the deadline for tariffs kicking in, a lot significant, particularly the goods exports had seen a front loading. Second is the front loading of government spending, where particularly capex growth has seen a robust 40% year-on-year growth. That all factors are indicating that a significant part of this growth has been led by somewhat one-off factors that may or may not play out in the next quarter, but for third quarter certainly have a significant impact of GST-led consumption uptick that will play out.
Thanks for that take. Depopam, talk to us about what this means for the RBI action that we're going to be seeing towards the end of next week. Inflation numbers have been better than expected this time, and this time the GDP number also has been much better than what the street was estimating. Does that warrant a rate cut? Does that make up for a case for a rate cut now?
5 minutes ago, I was like very confident about a rate cut, but with the GDP numbers, I hope the RBI doesn't take this too seriously, and the MPC doesn't consider this to be a significant signal regarding the fact that economy has come out of all the problems of COVID, which it has not certainly. So I still hope there's going to be a 25 basis point rate cut in December. And listen, the reason is very simple. Private capex is still in a very slow growth track. Okay, so only in the current quarter we have seen early signals of some risk taking improving compared to where it was in the last couple of years. We are seeing bond market issuances rise for sectors like chemicals, for sectors like manufacturing, particularly electronics manufacturing, as well as food processing. These companies are turning out to be major issuers in the bond market, and the appetite is also developing. But everything is hinged on the fact that the interest rate cycle, there is more room for the interest rate cycle to go down from where it is right now. So any shock or any surprise to that may impact the overall private capex cycle that we are so desperately waiting for, and that, as I said, this can become a little disrupting for the future growth prospects of the country. Secondly, the growth numbers are all very fine, and as Garima was also mentioning, and Aditi also alluded upon it, a large part of it is coming from the services sector, which is about 60-65% of our GDP. So that's the GDP is well taken care of. But remember the other part, the traditional segment of the GDP, which is seeing some growth, but acceleration is not there as much as the acceleration is there in the services sector, hires about 65 to 70% of our workforce. So at a time when we are going through this fantastic demographic dividend phase with more millennials and Gen Zs than baby boomers and the Gen Xs in the job market, it is very important to create more avenues to absorb semi-skilled Gen Zs and to a great extent many of the millennials, so that the job market keeps on being a major contributor to economic growth, particularly for this traditional segment of the economy, which may not contribute as much to the GDP, but creates a lot more jobs for the society, which usually have a very significant trickle-down effect on consumption. And then again, consumption is 60% of our GDP. So for this growth to be sustainable in the future, I think the rate, the capital cost incentive needs to be further strengthened. Capital cost needs to come down, private capex needs to pick up, and traditional sectors needs to strengthen much more than where they are today.
My question to you, Aditi, is that in the current GDP growth, where do you see the contribution of urban versus rural, and how do you see that shaping up going forward?
So interestingly, when we look at the expenditure side data, we've got yet another quarter of consumption growth, private final consumption expenditure growth being above 7%. We did expect that with the GST related boost that we got toward the end of this quarter, that we would end up seeing a good consumption number. And we have to see how this sustains going ahead. So if I look at urban versus rural, I think rural has been doing well in the last few quarters, and certainly this year's monsoon, although by the end of it there was a little too much of rainfall, but otherwise, when we look at the agri sector indicators broadly, they are projecting a pretty rosy picture. And the reservoir levels have also been very good, and Rabi sowing has kicked off in a very timely manner. And overall, so far, at least the farm part of the rural economy looks like it's going to be able to sustain its consumption. On the urban side, we got a lot of positive policy support this year. We got the income tax cuts, we got the GST rationalization that came in later. We've already got 100 basis points of rate cuts. And whether we get that final 25 basis points or not next Friday, we're still waiting to see. So urban consumption in aggregate should do better going forward. Definitely on the GST side, I think it's not going to be a one-size-fits-all across different sectors. The festive season saw a lot of pent-up demand for consumer durables coming through, including for really big ticket items like the auto sector. While I would expect that there will be a bit of a break from the very large ticket consumption after the festive season, the restocking will probably continue for the white goods. The auto sector, maybe because they were anyway sitting on very high inventories, it may not be as much of a positive volume impact going forward. And consumer non-durables, I think, will see an uptick a little bit later once people really reassess how much their household budget can stretch now. And overall, I also think that it's going to be a story of premiumization in many categories. So not necessarily volume increase for bigger ticket items, but definitely a story of premiumization going ahead. So I do think that the urban consumption patterns or the urban consumption sentiment should be better in the post GST period. One caveat, of course, is the sectors, households that are dependent on export-oriented sectors where there's a lot more of uncertainty because of what's happening with US tariffs, etc. There, the GST is only going to be a minor palliative. It may not really be able to spur consumption because there'll be more of stress in terms of job security and things like that.
Point taken, and thanks for that wonderful breakdown. But Aditi, Garima and Devopam, stay on with us. We'll slip into a very short break and be right back to talk more about these numbers and decode them better on the other side when we return. Well, back with the special edition of State of the Economy. We're talking about the GDP numbers that we've just seen. But in light of this, let's also talk about the capital expenditure that we've seen, both private and public. Devopam, in your view, the kind of public capex or the government capex that we've seen that has amped up, we've achieved about 53% of the target for FY26 in the first half. How confident are you of meeting this target of the capex? Because our sources also indicate that in this budget, there might be a 10 to 15% hike in the capex figure that the government may announce. Any thoughts on this, and where do you think we're progressing on the capex front?
Optimistic about the capex situation, not just the public capex situation, but also the emerging private capex situation. In fact, for the first time in the last so many years, government capex is finally crowding in or attracting private capex as well. As I was mentioning earlier, with the interest rates coming down, both for corporate India as well as the retail segment, there is once again renewed interest amongst medium-scale organizations as well as large-scale organizations to borrow to deploy in the field as greenfield or brownfield projects, which is a very interesting and encouraging sign. So I'm sure the government will continue with the good work that they have been doing. They should be able to meet the capex target of about 10 lakh crores they had for this year, as well as at the same point of time it will be complemented with a significant pickup in private capex, which the ball has already started rolling. It will gather a lot of momentum in H2 of this year as far as private capex is concerned. And remember, the maximum amount of job creation that happens, the impact of the trickle-down effect of private capex is way higher than that of public capex. So I'm expecting the issue of job creation, issue of quality employment also to start gradually getting resolved by the end of this financial year onwards. So this is a good time to be in India, to be specific from a business capex point of view.
To be in India right now. And Garima, weigh in and give us your sense on where do you think the risk to this sustenance in GDP could lie, because we're inching closer to a first tranche of the trade deal with the US, at least from the comments of the Commerce Minister earlier today. Macros are looking supportive. Rainfall this year has been very healthy. What could prove to be a risk to the sustenance of these GDP numbers?
I think on the positive side, I'll say whatever data has been coming, especially for auto sales, post-festive so far, 2 weeks after post-festive, the high-frequency data that you look at, the demand on entry-level segment and in general both EVs and four-wheelers have held up. So that is one positive signal. Second, you're not seeing an increase in inflationary spiral, despite the very concentrated and disruptive rains towards the end of the monsoon season. So despite damages, it's not just reflecting in increase in food inflation, which is positive from household balance sheet point of view. In terms of negatives, I think one big negative to watch out for is going to be the fact that the normal GDP growth, because the inflation is so low and the deflator is at where it is, the WPI at this financial year barely likely to touch a positive figure, we are seeing a normal GDP growth which is abysmally low. And such a low print of normal GDP growth does not bode well, and certainly does not bode well for earnings outlook in the economy. Our analysis suggests that every 100 basis point increase in nominal GDP tends to positively impact earnings growth for the corporate sector by 30 to 40 basis points. And remember, ultimately, what is growth? Growth is nothing but the nominal value of what is spent. And if the nominal value of all goods and services spent comes down, it will impact everything from your tax collections to your earnings growth. So I would say one risk to watch out for, and probably a not so positive element in the GDP prints of last 2 quarters has been very low nominal GDP.
Okay, so that's the outlook coming in. Nominal GDP growth also at 8.7%, looking very, very healthy. But with that, Garima, Aditi and Debopam, thank you so much for your time and your presence on this special edition of Eye on the Economy on our GDP discussion today.
Well, that was it. GDP